Hi everyone, welcome back to the channel. The S&P 500 has recently hit an all-time high. Much of this rise has been driven by technology stocks, especially companies connected to artificial intelligence. So the natural question many investors are asking is, are we in a bubble again? Today I want to explore that question calmly and rationally. Not with fear, not with hype, but with data and long-term perspective. Let's start with one important valuation metric, the Shiller PE ratio. You may have heard this term recently, especially when markets are at record highs. The Shiller PE ratio is also called the CAPE ratio. It stands for cyclically adjusted price to earnings ratio. Instead of using just 1 year of company earnings, it uses the average of inflation-adjusted earnings over the past 10 years. This smooths out short-term fluctuations and gives a more realistic picture of valuation. Historically, the long-term average Shiller PE for the S&P 500 is around 17. Today, it is close to 40. For context, during the dot-com bubble in the 2000s, the Shiller PE peaked around 44. So yes, by this measure, we are in a very expensive territory. That naturally makes people uneasy. But valuation metrics need context. The total market capitalization of all US publicly traded companies is roughly $72 trillion. The US GDP is about $30 trillion. So people ask, how can the stock market be worth more than twice the size of the economy? Doesn't that mean the market must be in a bubble? Not necessarily. The reason is simple. The largest US companies are global businesses. Their value is tied to the global economy, not just the US economy. That explains why market capitalization can exceed GDP and why valuations today may structurally be higher than in the past. But it does not simply eliminate risk. It simply means the situation is more nuanced. So now let's look at what is actually driving the market higher. The Magnificent Seven: Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla. Together, they represent more than $21 trillion in market value. That is over 35% of entire S&P 500. That level of concentration is extraordinary. Over the last 5 years, the Magnificent Seven delivered returns of roughly 250%. The S&P 500 overall returned about 83%. So when people say the market is soaring, what they really mean is a small group of technology stocks is soaring. This is impressive, but it is also a risk. Investors need to understand. So let's dive into AI, technology revolutions, and valuations. The real question becomes, is this just hype, or is this a genuine technological transformation? History gives us useful perspective. The Industrial Revolution, the Electricity Revolution, the Automobile Revolution, the Computer Revolution, and the Internet Revolution. Each of these permanently changed the world. And each one created enormous long-term value. But each one also experienced hype, speculation, overvaluation, and painful corrections along the way. The internet changed everything, but that did not prevent the dot-com crash. AI is real. It is already changing how we work, how we learn, how we create, how businesses operate. We are likely still in the early stages, but technological impact and stock valuation are not the same. The key question is not whether AI will change the world. It almost certainly will. The key question is whether companies can generate enough long-term profits to justify today's very high expectations. That remains uncertain. So are we in a bubble? The honest answer is no one knows for sure. Valuations are high, market concentration is high, expectations are extremely optimistic. Those are legitimate reasons for caution. At the same time, AI is a genuine innovation. Global business models justify some premium, and long-term progress does create real value. Both can be true at the same time. The bigger question is not, will the market crash in 2026? The more important question is, do you have a long-term strategy that can survive both booms and downturns? History consistently shows trying to time markets rarely works. Staying diversified, investing consistently, and maintaining discipline tends to work far better over time. So in closing, if you found this discussion helpful, please consider liking the video and subscribing to the channel. Here we focus on clarity, long-term thinking, and practical understanding of markets and money. Not predictions, not hype, but disciplined thinking. Thank you for watching, and I'll see you in the next video.